Okay, let me quickly explain the reducing balance method. As you can see on my table, I've worked out something. But first of all, let me read the question that I have. So the question reads, a business purchased a laser printer costing 1,800, costing 1,800 kwacha. Okay, that's a laser printer that a business purchased. The printer has an estimated life of 4 years. It has an estimated life of 4 years. 4 years, and then after which it will have no residue value. So the residue value is 0. There will be nothing. Okay, so this is the data that I have, and this is the formula for the straight line method. But under the reducing balance method, we use percentage, and then let's see the percentage that the question gives. Okay, the question is calculate depreciation using the reducing balance method at the percentage of 60% per annum. So 60%, that's the percentage they've given us for depreciation per annum. So to calculate under the reducing balance method, the depreciation first of all, 60%, that's 60 over 100 multiplied by the 1,800, the cost for an asset. So from here, our answer, we'll find that is 1080. That's our depreciation in the first year, okay? In the first year. But using the reducing balance method, let's see how our depreciation goes about. So this is our first year. Our cost and then our depreciation at 60% is 1080. So when you subtract, this will be your carrying amount. Okay, your carrying amount. Then the carrying amount becomes the value of the non-current asset in the second year. We've seen 720, 720. So the next depreciation will be calculated on the carrying amount, not on the cost. This is a difference of the reducing balance method from the straight line method. The straight line method, depreciation is calculated only once, and then you maintain that same depreciation throughout all the years, and then the accumulated depreciation, you'll just be adding the same depreciation that you calculated in the following years. But with the reducing balance method, depreciation is calculated on the net book value amount, on the carrying amount. So this was our carrying amount for the first year. In the second year, we calculate the depreciation on the same carrying amount, the same rate, which is 60%, and this was our depreciation. When you subtract, this becomes your carrying amount, and this carrying amount in the third year, that's the one you use to calculate depreciation on it, and then you find the depreciation is that amount, and then you subtract, and then this becomes your carrying amount. So in the fourth year, this was our carrying amount, and then since we are saying in the fourth year, this non-current asset had no residue value, instead of us calculating the 60% of this, the question tells us there is no residue value, because so if you calculate 60% of this, you find that the amount is different here, but we are subtracting the same amount that we have here, so that our carrying amount becomes 0, because the question tells us this non-current asset had no residue value. Therefore, we have to show it 0 by subtracting the carrying amount from the same carrying amount, and then we find that the asset is completely used in the business. So this is the difference between the reducing balance method and the straight line method. I hope I've explained. It's simple. It's actually simple and straightforward. Just go through this tutorial again and again, and it will be more of help. Okay, let me also wind up on the this part, recording depreciation in the accounts. Okay, recording depreciation in the books of accounts. So accumulated depreciation is normally an allowance for depreciation. This amount will be calculated in advance. That's what we mean by an allowance. Before we actually reach to this amount, this will be considered as an allowance and it will be entered in the books of accounts, appearing in the statement of financial position. And then we are going to have the depreciation expense. Depreciation expense. Depreciation expense. Okay. Depreciation expense. Depreciation expense, just by the name in the T accounts, when you do the T accounts, it's a debit entry. Okay. It's a debit entry. So it's a debit entry. So let's say this is the depreciation we've calculated in the current year, okay? And we are calling it this depreciation expense. And then we have the accumulated depreciation on estimation and allowance here for 5. This amount will reduce the value of the non-current asset in the statement of financial position. So our depreciation expense is going to be recorded here. 1.5, and it's going to, we are saying depreciation expense, right? Okay, depreciation expense right here. That's what we mean. So this is what our double entry means. Recording depreciation in the books of accounts. Double entry is going to be debit depreciation expense, and then credit accumulated depreciation. This is how you account for depreciation in the books of accounts. Please, I emphasize, read through over and over again to understand, because accounts has no excuse for any mistake. Don't make mistakes on these simple and smaller items. So basically, accounts has the way it treats each and every transaction. So if you follow through those transactions from the start, you will never have any problem. So in accounts, we don't guess. Every single item, it has a way it's treated, and this is what we are saying about depreciation. Okay, I have another question, and the topic here is assets acquired during an accounting period. Okay, so it's not always that a business will purchase non-current assets at the beginning of the accounting period. Sometimes it may buy in the middle of that accounting period. That's when they decide, or that's when they have money, and then they say, let's buy one non-current asset. Maybe let's buy a motor van, or maybe let's buy a building or furniture or any other non-current assets. Now that item has been bought in the middle of an accounting period. It wasn't there. It wasn't being used in the first place because we didn't have this item. Now we've bought it, and its importance has come in the business. Its importance has come in the business at the middle. What do we do? So the question that I have here reads, suppose that a business which has an accounting year which begins from 1 January to 31 December. This is the accounting period that this business uses, and then purchases a new non-current asset on 1 April. Yes, on 1 April. 1 April 20x1, okay? That's when the business has purchased this non-current asset, and the cost is 24,000 kwacha. 24,000 kwacha, that's the cost of this non-current asset, and the expected life of this asset is 4 years. Okay, 4 years. The expected life is 4 years, and its residual value is nil. We are not expecting to use this item at the end of 4 years. The residual value is 0. So let's do the depreciation calculation there. As you've seen, I've put up the formula for the straight line method. So our depreciation will come up to be like 6,000 kwacha. Now, is this the amount to charge as depreciation in 20x1? The answer is no, because this non-current asset has come in the business in April. So therefore, it's going to be used in the business only 9 months, 9 over 12. That's 9 months over 12 months. Then multiply the depreciation for the whole 12 months, which is for 1 year, and then do your mathematics here. You find that the actual depreciation for that non-current asset will come to 4,500 kwacha. So this is the amount you really need to charge in the book of accounts if you are going to be fair in your allocation of depreciation and charge in the statement of profit or loss for your accounting year. Unless the following year, which is 20x2, if this like the question says, it will be there for 4 years. So in the next 20x2, the whole 6,000 as depreciation is going to be charged in the books, because this item will be available starting January 1 up to December. So this is how you calculate depreciation. The month in which the non-current asset is available also matters. So you actually need to get familiar with this information. I appreciate your time. Thank you very much. This marks my end of depreciation. I've tried my best to explain. Get back to me if at all you face any challenges. The videos are prepared for Success Knowledge Center. Thank you and have a blessed day.